I'm Niels Christensen. Welcome to Kitco News and our continuing coverage of the Mines and Money Online Connect Virtual Mining Conference. Today, my guest is Andrew Ballingal, founder and chief investment officer of BIA. Thank you very much, Andrew, for joining us today.
Thank you for having me, Niels.
So we've seen gold have a pretty good run this week. Sort of got in that line of 1800. Let's just jump right into this. What are your thoughts on the precious metals in this environment?
Well, we have been for the last 4 or 5 years bullish on gold. We correctly identified the lows some point in 2015-16 on the basis that gold had got down to marginal cost of production, that we regarded the threat of a material rise in interest rates as very low and risk is generally underestimated. And obviously the gold price is now up 60-70% from those lows. But we have had and continue to have a target for gold in the early 2020s of north of 2000, predicated on our view that risk, both in financial markets and in economies, but also more importantly, that's become very apparent in the last few months or years, that political and social tensions would rise. And in that environment of rising risk, not only would volatility in financial markets go up, which is typically associated with declining prices for those assets, but the general estimations of political stability, social stability would rise. And that tends to presage things which make people nervous, like inflation, like confiscatory taxation, like capital controls. So a lot of the traditional drivers for gold as a last resort seemed to us to be minimal 3, 4, 5 years ago, but very good prospects of being significantly higher in due course. We always call gold, it's a handgun, and a handgun in Fifth Avenue at noon is one thing, a handgun at 4 a.m. in the Bronx is something quite else. And, we're going from noon on Fifth Avenue to 4 a.m. in the Bronx in our view. So gold will become a very much prized asset.
So as part of the Mines and Money conference, you were part of a panel that talked about how investors can capitalize on this bull market. So what advice do you have for investors out there? I mean, is it the raw commodity? Is it equities? How should investors position themselves?
Well, I think the most important thing is to get involved. One of the reasons we continue to be very bullish about gold and gold-related investments is because they remain tiny in the context of global financial assets. And if you look at gold the mined gold is $8 to $10 trillion roughly. The vast bulk of that is held by governments. It's not to say that it can't be sold, but it's not in conventional investors' portfolios. There are ETFs, but they're relatively small. The market cap of the precious metals mining companies is around $500 billion. That comfortably fits in Tim Cook's left pocket. I mean, it's nothing in the big scheme of things. Global equity market capitalization, depending which day of the week, with these volatile markets, somewhere between 80 and 100 trillion. US is roughly 35-40% of that. You can see that gold stocks are almost not represented in most people's portfolios. Traditionally, metal has been held in emerging markets by poor people as both jewellery and savings, and there's no doubt a stock of it there. But most people own virtually no precious metals exposure. In my view, that is completely insane. they should have at least 10% and probably at least 20%. The easiest, simplest way to own gold is physically, and it has the huge advantage of being unintermediated. It does then require storage and insurance. You can buy financial instruments exposed to gold. If you're an apocalyptic, these aren't going to be very good, because one of the problems that will emerge if we get to really tough times is probably some of these intermediated products will prove very unreliable. It's like buying insurance from an insurance company that doesn't pay out. If you want the biggest bang for your buck, in our view, the right way to go about it is to buy a portfolio, a diversified portfolio of well-managed precious metals mining companies. And that's what we do and run in the BIA Gold Fund. And that will outperform gold in a rising gold environment. It for various reasons, not all of the time, depends on how low gold shares have got and the various points where they've outperformed declining gold price. But on the whole, the best environment for gold shares is obviously relative to gold is when gold is going up. And it's worth pointing out that, gold has massively underperformed conventional shares, S&P and particularly NASDAQ over extended period. And gold shares have significantly underperformed gold, and junior gold shares have significantly underperformed both gold and major gold shares. And our conviction is very strongly, and has been for some time, it's only really paid off in the last 6, 9, 12 months, is that medium and smaller gold mining companies, for the most part, will do better than large gold mining companies in this continuing bull market. We see this very much as the foothills, not the summit of this bull market in gold and gold mining.
You make some interesting observations, about how small the gold market is, sort of compared to, it's the entire mining sector is an expensive lunch for a tech company. I guess, do you see generalists taking a look and being more involved in the mining sector? Like you did mention, virtually no investor holds a gold position. So I'm sort of wondering, are you seeing more money come in, and is it easier to attract investors to your fund?
There have been tentative moves. I think there have been two main phases of that from non-specialist mining. But the real value hounds, the really smart value investors, leapt on gold in the autumn of 2015, beginning of 2016, because they saw gold as very low relative to its marginal cost of production and its portfolio utility, which is it's a very, very good diversifier in a portfolio. And at the same time, gold shares were selling at extremely low valuations relative to their net present worth or cash flows, even based on a very low gold price. So we had an influx there, and some of that stuck around. Some of it came out with the subsequent recovery in both the gold price and gold shares. And then periodically we have clusters of terror in the conventional world. We've obviously had a more recent one based around either financial market instability or fears that inflation is going to resume, and you see generalists begin to come back. But it's very small, it's very tentative. It is, to be fair, very hard also, because as I said, the total market cap of precious metals mining shares is only $500 billion, and 80% of that is accounted for pretty much by 20 companies. The top 10 account for 15. The top 15 account for a very high proportion of it. So there aren't a large number of institutionally investable gold mining companies out there. And it was a problem, but it's, in our estimation, much less of a problem, that for an extended period, the reason we didn't like the large gold mining companies, firstly, the math is against you. If you're producing 5 million ounces of gold a year, you've got to replenish that. You've either got to find it or buy it. And on the whole, these companies showed themselves to be disastrous pro-cyclical asset traders rather than contra-cyclical, which you need to be. So the math is against you. Secondly, the valuations, typically you pay, in our view, a lot of the time excessive premium for liquidity and diversity. And remember, there's no huge synergies in gold mining. Each mine is a mine. There's not a lot you can do about it to bring them together. So the premium, the valuation was unhelpful. But the most important factor in our dislike of the large gold mining and mining companies generally was our perception that they were very poorly managed. There's virtually no major gold company today that is run by the same people that ran it 5-6 years ago. There's a whole new raft of senior management in these companies who've got to where they've got to by doing well in smaller or medium companies, and have learnt lessons, and on the whole they're rather well managed, and some of the biggest companies are the best managed in the industry, so that's not a problem now. But the perception amongst generalists is you've got 3 or 4 strikes against mining. One is it's obviously not environmentally friendly. 2, that it's been poor stewards of capital, badly managed. And 3, it's done rather badly in share price terms a lot of the time. And anyway, it's so small, it doesn't really matter. Everybody allocates assets in the rearview mirror. And until it's really hurting performance not to be exposed to gold or gold mining equities, most people won't do anything about it. That's just human nature.
So what do you think drives more generalists into the mining sector? Is it a higher gold price? I mean, we're already seeing really good margins for a lot of these companies. We're seeing companies give a dividend or increase a dividend. So I'm sort of wondering, like, what do you think is the spark that ignites? Is it just time that investors will eventually wake up, or does something need to happen to grab their attention, like $2,000 gold?
I think you've touched on a whole range of things. One of the groups of non-specialist money we see coming into gold shares actually are quantitative funds who've picked up on the structural improvement in the profitability cash flows of gold mining companies with higher gold price and better controlled costs. So that's definitely a factor. I think psychologically taking out the old high, the September 2011 high, will be helpful. There is an increasing groundswell of intelligent macro opinion that inflation is now in the wings. We've been resolutely of the view that it hasn't been, and that's been the right call to make, notwithstanding the tremendous infusions of liquidity over the last 10-15 years. I'm more open-minded about that, and I can see the possibility of inflation arising further down the road, although that's not the immediate expectation here. And if that's the case, then obviously bonds are completely the wrong price, and equities are completely misvalued. Now, it might be that equities do all right because inflation helps them grow their earnings. That wasn't, by the way, importantly the case in the 70s, where most companies suffered horrendously from inflation, because to get inflation going, you've got to get wage incomes, you've got labor share of the economy needs to rise, and on the whole that works against the interests of equity owners. So I'm skeptical whether equities are a good hedge to inflation, and it's particularly not the case where you get into taxation traps like we had in the 70s, where companies were getting taxed on inflation enhanced profits at very high levels. So I don't see either equities or bonds as benefiting from inflation, although bonds will obviously be the prime casualty. But I do see super long duration assets like gold with no income associated with it directly, and gold mining shares that benefit from the higher gold price as significant beneficiaries of that. Now, that's not why we like gold. We like gold because we think gold is a very safe asset in a very dangerous world. And that danger can manifest itself either in inflation and, in my view, taxation, capital controls, all sorts of things not terribly helpful to necessarily to all owners of capital, or it can manifest itself in real crisis in the economies and financial systems that lead to disastrous price outcomes and disastrous function outcomes. And gold is not completely immune from that, but it's certainly better protected than most. And we could easily see a scenario where the gold price goes down by 20 or 30%. But if everything else goes down 70, 80, 90%, obviously the purchasing power of gold as a financial asset will have risen. It won't have risen as much probably as cash. If we're in a non-inflation environment, it won't. But there are ways that gold can protect without going up. That's probably less helpful to gold mining shares, but it could be that their costs go down even faster than the gold price goes down in a deflationary episode. So I don't rule out gold shares doing quite well in that environment too. And relatively, I think they'll do very well. We're not terribly interested in relative, we're interested in absolute. That's why I think you do need to have a mix of physical gold and, as I said, a diversified portfolio of well-managed gold mining companies.
Andrew, thank you very much for talking with us today. Fantastic conversation. I really liked how you described gold as this protection in your portfolio in dangerous times.
I mean, that's been its traditional role, and I think the risks now are, to me, greater than they were when we first set out on this. In as much as it's much clearer that the risks are not confined exclusively to the economies and financial markets. We've always maintained that the next serious market event, an economic event, recession, bear market, whatever you want to call them, would have very major social and political implications as well. And I think in that environment where it's so much harder to forecast what's going to happen, if it's a recession or a bear market, we've been through a lot of those. I've been looking at markets and gold shares since 1982. These things happen. What doesn't happen very often is what's about to happen now. And look, this is long before we had any mention of COVID. And I'm reasonably confident the gold would be not far off where it is now, with or without COVID. I don't see COVID as a net factor in what's happened to gold so far. I think the risks are that COVID is one of the fracturing elements that leads to a much worse outcome even than we'd anticipate in economies and markets, therefore in societies and politics. So whatever we thought about gold at the beginning of the year, we think about it in spades now. We're much more convinced bulls about it. And the roster of alternative investments that make sense given where we are now has narrowed even further.
Andrew, thank you very much for your time. And it's been a pleasure talking with you today.
Great. Thanks, Neil. Also with you. And thank you for having me.
Thank you for watching Kitco News. For all our coverage from Minds and Money Online Connect to Mining Conference, go to kitco.com. Stay safe and stay healthy.